Hi everyone, Paul Lang from DTS. I want to introduce to you what you're about to watch. It's an hour-long event that was presented live to free members at Discipline Trading Strategies. This is called Techno-Analysis is Great, subtitle, a couple of tools you can use right now. I'm going to go into detail on a couple of very minute examples of what makes up reading a chart, what makes up the language of charts, and go into detail to show you how incredible some of the small tools are that you can use. Naturally, you have to put all those small tools together, the big tools, to really understand what you're doing. But it'll give you a great understanding of just what is involved in technical analysis and how it can really turn the odds in your favor. As you all should know, the only way to make money in the market is through the use of technical analysis, understanding how to read a chart. If you enjoyed this one, check out the many other educational videos, articles, and Trade of the Week videos you can get access to at the Free Stuff page. Just check out the DTS homepage and go to Free Stuff. So sit back and enjoy this event. Good evening, everybody. Sound check. How's the sound out there? It's 5 o'clock exactly on the East Coast of the United States. All right, I'm going to get right to it. All prepared, all set for tonight. I sent a quick little blurb around, kind of introducing tonight, a little special note, just kind of saying, these events are all a little bit different. Some focus on some psychological topics, some focus on, what not to do, and some focus on some light technical topics. So this is going to be, more the extreme of kind of a teaching event for some actual technical things. I hope you all understand the goal of these is a couple, threefold, fourfold, several things of these events. I mean, number one, for a lot of people who are out there trying to figure out what to do, they can be good, useful tools to help you. For some of you who are doing pretty well on your own, however you learn, these can be great little extra tidbits to learn. What they are not, though, they are not a replacement for learning how to read charts, and there's never been that intent to that. One of the goals is that I hope that some of you who are deciding what to do become, impressed with understanding how great technical analysis is, i.e. the title tonight, and how much there is to learn. And maybe someday you decide to get educated, maybe here at DTS with me. It's one of the things that I do. I've trained a lot of successful traders, but I don't push it a lot. It's the type of thing that you have to want to do and have the time for and be ready to do. It's not hard to learn. People can do it, but it also is something that does take a little bit of time, and it's not just an automatic. So let's get started with tonight. I've been running a little bit late on these the last couple of times, so I want to make sure we're kind of done here by 6 o'clock. Technical analysis is great. A couple of tools you can use right now. That's the slide that got sent around to you. Technical analysis is how you make money in the market, any market. It's fairly simple, but involves a different approach than most use. Most think it does not work well because they never learned it properly. You've heard me say a lot in the past, by I think the end of last year, one of my big focuses was the difference between an A or A plus understanding of technical analysis and a C plus or even a B. A C plus, you're never going to make money. A B understanding, you maybe break even, maybe make a little bit of money, but you're struggling. So you really have to get that really great understanding of technical analysis. And hopefully these are a couple of small points, but they're really big points. They're really huge things. So the slide says, let's begin. Getting right to it here. So number one, I want to teach to you the best use of volume. Now please understand that when I actually teach this in class, this is a big topic. It takes some time. But I want to hit on you with an example and the number one thing that you can do with volume. The slide says, entire books are written on volume. Most of that book is useless. There are 3 uses of volume that can make you money. One is the best, or at least the most useful. Other than those 3 concepts, the rest are nice talk at a cocktail party, but only distract and will never make you a penny. Unfortunately, as you can probably guess, the most common uses I hear of volume are the ones that you should use at a cocktail party and not when you're actually trading. So I'm going to show you the best one right here as an example of a trade I did yesterday, Monday. And then I'm going to mention the other 2 good uses, and I'm going to show you some examples of cocktail party talk. Does that sound good? Everybody got the plan here? So here's number 1. This is Monday. This is the chart for Monday. This is the MPW trade. And the strategy concept doesn't really matter. What is involved here comes in actually taking the target. So this is a daily chart, and this is from Monday. It's going to gap down to number 1 right there, and then it's going to rally back to number 2, which is where I'm going to short it. So just showing you the daily chart is a general concept of what's going on. So let's take that and go down to the intraday chart. So we're going to open down here on the 2-minute chart. Here we go. Ready? Daily chart, 2-minute chart. So there's that open. There's that gap down. And we run up in here, and I shorted 467 by 501. Note where my stop is. My stop is above this area up here. So really using kind of a wide stop. And it starts to drop, and it drops right away. This is what you love, of course, in the morning, is you get into something 3-4 minutes into the day and just, immediate gratification starts dropping. You're in the green, you can bring the stop down, you're thrilled, you can look for another trade. And then it starts moving lower really quickly, 2 minutes, 4 minutes, 6 minutes, 8 minutes. And we get in this 8-minute bar, and for that quick of a move, what I tend to do, those of you in the room know, is I take what's called a cheap third. I don't like taking cheap targets in general, but there's some reasons sometimes for one purpose. If I can get a cheap third out of the way and the stop comes down, this trade is green and I can go on another trade without worrying about, having a 2 or 3 hour loss. So I do tend to take that. So as we started to drop right in here, I started trailing a third or a half, I don't remember what it was, in here, the cheap third. So I'm trailing this. And I trailed it well enough or it was dropping fast enough. And by the way, this is what I love about shorting as compared to going long. You don't see this going long very often, right? If I flip this chart over, those of you that trade during the day, you agree that this is like, a 90% better thing about shorting. You don't see this very often on the long side, right? Everybody? Anybody with any qualifications to answer that question, right? You don't see that much. I mean, sure, anything happens, but I mean, this is not all that unusual on the downside. Things just drop out of gravity because, people on the wrong side. So it drops quick enough that, and that's the other great thing is that it's not only quick, but it's easier to manage. So I'm trailing this, I'm just, I don't know what the numbers were, but okay, trail third, 451, 447, just kind of following it down, following what I call tick chart pivots. And then all of a sudden, boom, we get down to here and I switch and I say, I'm taking it all. In other words, I trailed it, but I said I'm now trailing all of it, not half or a third. Now, I don't normally do that. It's probably 1 in 10 trades that I just take the whole thing right away because I like to get some bigger moves. Why? Why at number 2 did I switch and say, whoa, taking it all? Why? Yeah, you'd have to. You would have to be not completely there if you didn't know the answer because look at the title of today's presentation and the title of this section, right? Great uses of volume. So we had the biggest volume bar on the chart, and it happened to be coupled with the biggest bar on the chart, right? Yeah, I mean, call it climactic. I mean, that kind of has a specific meaning, but remember, I'm not entering this long. I'm just taking profits short. There's a different standard. In other words, I may not jump in this long necessarily, but if you're long, if you're short and you're taking money, you take your profits. That to me is one of the greatest uses, is the greatest use of volume, period, because it's something that's very useful. So now keep in mind, this in a vacuum is fairly meaningless in terms of being any kind of strategy. It's nice if you're going to, this is an example of taking a target because of the volume. That's pretty simple. But if you're going to enter a strategy long, this can be helpful. It can tell you, hey, maybe this is the right moment, but you still have to have some kind of strategy long. You can't just jump in willy-nilly because the volume increased. And remember, some increases in volume may mean that you're, starting to move in the opposite direction of what you think you're going. So that to me is a super example. Do I have any notes here to say? And it's all because of that volume bar there. And look what happened. That was, now to me, that's never a great long. Why is that not a great long? Here's a good question. Why is that not a good long down here? Why wouldn't you flip and go long? Everybody likes to flip things. Why wouldn't you flip that and go long? One of the most important answers that you should know. No, I mean, you're too specific, Stephen. Yeah, I mean, Jay kind of has it. Yeah, there's no strategy to be long, right? See, to me, it's extremely rare to flip. Because to me, any good trader, your trading strategy has to come from above, right? If you go back and look at this was a short setup only. This is a short. From the daily chart, the hourly chart, we gapped under an area, it's a short. Just because the short maybe is ending, it doesn't mean it's a long. So that's an important thing, is that an entry is a complement to a strategy. So that's the concept of getting out because of the big volume increase, the big bar. It's not a long simply because there's no strategy to be long, right? You follow? It sounds simple here, but I can't tell you how many times, like in the room or just the questions I get, People don't seem to get that. It's the tail wagging the dog. It's, oh, look at this 2-minute chart. That looks like a long to me, but you're playing it inside of a 15-minute downtrend. No, it's not a long. Everything has to, not everything, but certain things have to come together. So I happened to nail the bottom. Where's the exit down here? 36. I mean, I nailed the bottom within 3 or 4 cents. Perfect exit because of the volume, because of the wide range bar. But I would never want to go long that. That'd be stupid. Matter of fact, I'm surprised it held that well, but it was the low for the day. It never touched that again. So there's, to me, number one concept. So let's move on to some other questions then. Moving averages would have been indicated on a 2-minute chart. Shorts might be covering. Mary, I would, sorry, but if you put a comment, I think you want my opinion. Moving averages are completely irrelevant to that concept. There's nothing. Why not the moving averages on a 1-minute chart? What would they tell you? Or a 5-minute chart, or a 60-minute chart? And what if you use exponential or simple? Or what about the 8? Or you know what I mean? It's the moving averages are. See, it's funny on this chart, Mary. Just so you know, I keep my moving averages on there for a certain reason. Matter of fact, that's one of the things I'm going to talk about. But when I look at, like, for this chart for this purpose, I don't even see those moving averages. I literally don't see these because I have no use for them. Ironically, Mary, I'm actually going to talk about moving averages as one of the third or fourth topics to talk about in a minute, and how you can use them. They are so meaningless on this chart. I literally didn't even see it. If you like shut down my screen and said to me, well, I know what I keep on my chart, but if you said to me, Paul, did you have moving averages on there or not? I would have to be like, I don't know. I'm not even sure because they're not useful to me, right? No, crossovers, Mary, I can't emphasize enough. We're going to talk about it in a minute, but crossovers are meaningless. They're completely meaningless. You're the number 22. If you look for it, you will find it, but they don't mean anything. I mean, I'm not sure how exiting here that you could look at the moving averages and say they told you anything. We care about price. You have to focus on price. Price is where it's at. The bears and the bulls battle. The bears puked out. They exhausted themselves. That's the end of the move. I don't care if you have an 8 exponential, a 20 simple, a 200 arithmetic. None of it matters. None of that matters at all. No offense, but the sooner you get away from that, the quicker you'll develop because you're just seeing mirages. But anyways, let me go on to this one real quick. Here is, I have the chart covered up so you don't know what it is. I'll show you in a minute. So here is this daily bar on huge volume, right? That's like twice the average volume for the last 4 months, right? Twice the volume. Gap up, and that volume is what? What is that volume to you? Is that bullish, bearish, neutral? Any comments at all about what that volume means to you? We're here, talking about things about volume, and there's a huge volume bar on the chart. I want to know what that means to you. It's bullish. It's novice. Okay, that'll be kind of opposite answers if I'm reading that right. Novice would mean you think it's coming back. Well, that's an interesting question, Mary, but let me ask you this. For those of you, whether you said bullish or novice, why? Why is that bullish? I'm not saying you're right or wrong. I'm just asking a question. There's a big bar there. We have a daily bar sitting there. Short covering. So would that be bullish or bearish? Mary, that huge volume bar meant that longs were selling. Well, here's a question for you, Mary. If the longs were selling, weren't there also people buying? If there were a lot of people selling, there's twice the volume in this bar. If there were twice the people selling, weren't there twice the people buying also? Well, that's possible, but does that have anything to do with the volume? See, here's the funny thing about volume that people seem to ignore, is that for every buyer, there's a seller, right? Is that true at the end of the day? For every buyer, there's a seller, is that true? Well, I'm getting to it, Mary. So for every buyer, there's a seller. That means whatever you say about this bar, there's twice the buyers and twice the sellers. So how does that help me? I agree, Mary, but that has nothing to do with the bar. Do you understand my point, though, Mary? Whatever you're saying about whatever it is, and whatever you think is bullish or bearish, well, if you're bullish, people typically say, oh, well, there's twice the buyers in that bar, right? Or if you're bearish, you're saying there's twice the sellers in that bar. But the point is, there's the same number of buyers and sellers. Is that true or not, Mary? In that bar, there are the same number of buyers and sellers. You can't sell to nobody. You can't sell to the air. When you sell, somebody buys, right? One may be smarter, one may be dumber. Well, here's the comment to this. is that, let me give you the answer because we have to move on here. I just want you to really think about this, right? Yeah, well, if it's the same number of buyers and sellers, isn't that a tough question? I mean, people just look at it sometimes and say, oh, blah, 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 but what does it really mean? And here's the answer for you. I mean, to me, that volume bar, and again, we're in the category here now, which this is water cooler talk, right? This is meaningless. That volume will never, ever make me a penny. Let me say that again, because this is one of my famous things I like to say about educating and learning charts, is that I hear a lot of people say things, out there in the trading world, and a lot of them I have to say, you know what, that's never made me a penny. You can say what you want, you can think it's this, you can think it's that, but the truth of it is that volume is meaningless, right? And by meaningless, maybe that's not the right word, because maybe it has some meaning, but I can't tell what meaning it has. Nobody can. And here's the comment I wrote down to say, volume, you ready for this? Here's the bottom line. Volume is only meaningful to the extent that it can emphasize an underlying pattern. And I picked this chart, and this, by the way, happens to be Tesla. And actually, most people, what most people, and this is not even a joke, but do you know what most people will interpret that volume to be? Most people will interpret that volume to be, anybody know the answer to that? Yeah, I'll give you a hint. Most people will interpret that volume to be, and this is absolutely true, electric. It's electrifying. They will interpret it to be whatever their opinion is of Tesla. I wrote an email a while back that amazed me. Bill, I wrote it, writing the email didn't amaze me, but the topic I wrote about amazed me. I did a trade on Tesla a couple, 3-4 months ago. I don't trade Tesla often because it's just another stock. It doesn't mean anything to me. I could care less who it is, who owns it, what they do. But I did a trade. It was a good trade and became the trade of the week. That trade of the week had 2.5 times more views than any other trade of the week. Why? Because it's Tesla. There's people that just want to trade Tesla because they like it, they hate it, whatever. And believe it or not, I mean, subjectively, a lot of people just look and say, oh, I love Tesla. Yeah, oh, that's bullish. Well, it's not. I mean, and the reason I picked this is because the volume just emphasizes whatever chart pattern is there. And the question is that chart pattern bullish or bearish? You know what? Bigger picture, like if you back up from up in the trees and look at a weekly chart, it's probably bullish. But I mean, for the immediate future, for the next few days, it's just kind of neutral. There's things pointing both ways, which brings me to another important comment. Yeah, Tesla's even lower today. Tesla's lower today in a bullish market. But it brings me to another important comment, and this is, to me, one of the most important comments I could ever teach you about trading, and that is very simply, the reason I like to trade stocks instead of futures or Forex is because when I see a chart like this, you know what, Mary? I don't have to figure it out. I don't have to figure this out. I can just say, I don't know, next chart, please. Give me something I understand, right? Now, if you make me figure it out, I say, okay, fine. The volume is not part of the consideration there at all. On a daily high volume shooting stars, give me sellers selling the good news and to move. Yeah. Yes, your shooting star explanation is an example. It is an example, Mary, of what I showed you on the first slide, which is what we call puke out volume. It's that big volume after a long move tends to exhaust the end of the sellers or the buyers. Think of it this way. I thought of this example to teach you this. And actually, I think it's a pretty good example. And you don't have to be imagine you're playing poker, right? You're playing poker at a table. And where's my circle? You don't have to be a poker expert. I played my share of poker in my youth. So here's your pot of money, right? And you look across and the other guy's got the same size pot, right? So here's all your chips in here, right? Looks like a pizza. Looks like a pepperoni pizza. So let's say you have 100 chips, right? Could I drive this guy out of the game by betting 50 chips? The answer is no. We each have 100, right? We each have 100. We each bet 50, right? That's a big bet, right? It's half the money, but it doesn't affect either one of us other than what our cards are showing. You see, what a great example this is, right? So it's a huge bet. It's half of our pots, but nobody's getting any advantage there. It just comes down to what our cards are, right? But what if my opponent, I had 100 chips, what if my opponent only had 10 chips? Because he exhausted his chips over the last 5 hands. He lost 10, lost 20, lost 10, lost 20. Now, what if I bet 50 chips? right? It doesn't really matter what my cards are anymore. You see what I mean? That's kind of what the volume thing is when you run out of sellers and then vroom, you accelerate and all of a sudden, boy, there's no sellers left. Literally there's no sellers left. All right. So that was back talking about good volume. This is meaningless volume. Let me show you another chart here. This is a 5-minute chart now, and you can see that, again, this volume, this bar right here had bigger volume than the last 12 bars, 15 bars. Exhaust buyer demand, interesting. Yeah. Market makers see this pattern all the time, so would know to short right, is it? No, Mary, I think you are over glamorizing what a market maker can do or what they do. Despite popular opinion, they're not in there taking your money or manipulating things or people think this, the whole thing with market makers, most people use that as an excuse. Oh, the market maker took my stop and did this and did that. And, it's your fault if that happens. And they can't do that. I mean, I happen to know a couple of market makers and one of them is typing in the room right now. I mean, they're lucky to, they don't get to eat lunch and they're lucky to even, keep conscious during the day just doing their job. So no, I mean, it's not really it. It's just simple. There's bulls and there's bears. They battle all day, and sometimes you get a glimpse into who's winning, and that's all there is. How about this chart here? How about this chart here? Love the comments, Mary, by the way. How about this chart here? That bar there had bigger volume than any bar other than the opening bar, which frequently is a high volume bar. A lot of times the pre-market is poured in the first bar, so sometimes that volume bar is big. I'm not really sure if that's a rule, if they have to do it or not. What does this volume tell us? Is this volume bullish or bearish or what? Bullish or bearish? Right there. That guy right there. Bullish or bearish? Now keep something in mind. We just broke the high of the day, but we also were up a little bit. Longs taking profiting. But are longs taking profiting, is that bearish? Is profit taking bearish? There's a great question. Matter of fact, I have a comment here to discuss profit taking on a slide. We can do it here. Is profit taking bearish? Profit taking, I'm going to teach you another one here real quick that I teach in class. Right, profit taking based on that word alone is not bearish. Here's what can happen. When you run up, right, people have profits built in. These people that traded this, and you get up here and the conductor kind of says, hey, all right, some of you want to take some money, go ahead. We'll let some of you, so some people take some profits, maybe some people take everything. Maybe some people take nothing, and some people take some profit, right? But it's like a nice orderly transition. It's like, okay, who wants to get off? You guys want to get off? You want to get off? Okay, everybody done? Okay, let's go higher again. Where the problem comes in is not, I call that profit-taking selling, or you might call it a pullback. Where problems come in is when this runs into something over here, a big glob of ugly sellers, and then it's not profit-taking, now it's selling. And that's one distinction you have to have. So again, for this volume here means absolutely nothing to me. This is something we could sit here all day and you guys could discuss it and you could all have good points and I could say, hey, blah, 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 blah. But at the end of the day, I'm never going to learn anything from that and I really don't care anything about it. You could argue that would be a reason to take some profits on that run up. But it depends what your plan was. I mean, if you're looking to hold it all day, I wouldn't want to get out there because of that volume. If you're a scalper, you'd probably be out anyhow, whether there's volume or not coming, right? It's just inconclusive. It just simply doesn't mean anything. Too far away from the moving average always, right? Well, that, Mary, actually is a proper purpose of the moving average. We're going to talk about that in a minute, right? Well, it's whatever, Mary, I look at all the time frames and it is whatever time frame is applicable to what I'm doing. If you're holding something or looking for a target in 10 minutes, you're on a 1 or a 2 minute chart. If you're looking to hold all day, you may be on a 15-minute chart. So that's all. This was chosen just because I just want to show an example of volume that again I think is really nothing. I have 4 monitors for trading and 3 of them are filled with charts. Yeah, we can talk about that more in a minute. Okay, so the first chart I gave you the best use of volume, which is what I call puke out volume, very, very useful. The next 2 charts showed you example that to me the volume had no use at all. It's just futile to sit there and look at it, discuss it, And it's the type of thing that people will write about and talk about, and it's the type of thing that fills up books, but is meaningless. You're never going to make anything from that. Now, the other two types of useful volume, remember I said there were three really. The other two types are what we call igniting or continuation. They're useful, they're good, they're part of what I teach, but they're a little less useful. I'm not going to go into those now, but those are the three things: the puke out volume, igniting volume, and continuation volume. Those are the three types of volume that are useful. The puke out volume that I showed you in the beginning is the most useful. But let me give you a couple other things that you hear a lot. Dumb comments about volume. So this now we're back in the category of, hey, you hear this a lot, but it's meaningless. Yes, the market has been higher for many weeks, but I do not trust this rally because it's happening on light volume. You ever hear like the pundits say that? Yeah, I mean, what a stupid comment. Well, you know what it is? It's a great hedging comment for them because they can just keep saying, well, yeah, we're going up, that's okay. And then if it ever falls, they can say, oh, see, I told you, you got to watch the. The truth of it is, if there's anything, a light volume rally is bullish. Why? yeah, the advanced decline line isn't confirming. Well, I think the thing of it is just this case that there's a limited number of buyers, even if it's 100 billion, and the less people that are buying into the rally, the more we'll have to buy into the rally. Right? We're not using up buyers, right? I mean, what you actually don't want to see is a market that's accelerating after it's already been up a while on huge volume, because now you're burning up the people who want to take you to your target. So if anything, it's kind of bullish to see that happen, but it certainly isn't a reason to not participate. It's just a stupid comment. Let me give you another one here. Let's do this one here. And maybe we already have the answer to that one. So this is a hand-drawn chart because it's too hard to find one exactly like this. But here's price candles, right? Red bar, green bar, red bar, green bar. Then we have the infamous doji, and it's red. And here's the volume down here. Boom, 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 boom. Huge volume on the doji. That last candle, would you interpret that as bullish or bearish? Triple the average volume on that candle. What do we do? Well, the reason this chart's like this is, yeah, you made a new high, but then you kind of collapse back below the resistance area. Interesting, the comments that I'm getting there. Some people saying, well, it's, broke above that, kind of failed. But specifically, I want you to focus on this pattern. I tried to draw it kind of neutral. What does the volume tell you? We have a huge red candle with a red bar. Does that make it bearish at all? Well, you'll see the point. I think you guys already kind of have the idea of this from our prior discussion already today. I'm going to change the slide. Watch it carefully because very little is going to change. Watch what's going to happen. Next slide. Now we have a huge green candle, huge green volume on a green candle. Is this more bullish than the last slide? Well, I think volume bars are very useful, Mike, for very limited purpose. Yeah, most of the time I don't look at them, but for the three reasons I said, they certainly, yeah. All right, good. See, one of the really dumb things I hear all the time is you see a candle floating out there, and it's a fairly small candle, and but it's got huge volume, and they'll just look at the color of the candle and say, oh, that's really bullish because it has triple the volume and it's a bullish candle. Well, obviously, the answer to this then is, like I said back in a few slides, the volume is only indicative of the underlying pattern. It would be silly, wouldn't it, to say that this is bearish and this is bullish when the candle closed 2, 3, 4 cents lower on one than the other, right? It's a very random thing where something closes. So good, you guys got that one. That's I think a fairly simple one, right? Right, completely irrelevant, exactly, right. It would only matter if it was associated with a candle that meant something. Otherwise, the volume associated with it is irrelevant because there's as many buyers as sellers in that candle. All right, so number 4 we're on here. That was 1, 2, and 3. Number 4, the uses of moving averages. There is one good use for moving averages. There is a second use that is helpful in some cases, but is counterintuitive. And there are some concepts about moving averages that are simply fallacies. And unfortunately, most of these are some of these are the most popular uses. So let's do quiz time again here. We are going to gap this day. This morning, the stock was gapping below the 200, and we're already below the declining 20 and the declining 40. So gapping below the 200, bullish, bearish, or you're just going to say that's neutral? That gap down, and you don't see enough of the chart to understand the gap. I'm just asking, when you factor in the moving average, does that make you more bearish or more bullish when you factor in the moving average? So you're not seeing enough chart. You'd have to have the weekly chart to get an actual decision about what's going on here. But I'm just saying, whatever your decision is, there's the moving average or gapping under. We were holding the moving average, and now we're gapping under it. Is that bullish or bearish based on the moving average? At 200, strong possibly. As you see, support and resistance MA is used by some. But that's what we're going to talk about, Mary. So listen to the rest of today, because used by so many. But you know what the so many is? It's all the dum-dums like me and you, and that don't really make a difference. Well, I mean, I am too, Mary, in terms of making charts. I don't make charts. I follow charts. And the people that are smart aren't smart. They just have all the money. So somebody with a lot of money could do totally the wrong thing, but yet you'd want to follow them because if they can move the chart, they move the chart. The point here is, again, when I'm looking at something like this, that moving average, I don't even see it. I was doing a gap the other day in a gap class last Sunday. Somebody mentioned moving average, said, you know what, I've never even seen that. I don't see this moving average. It's completely irrelevant. Now, I want you to think about this a minute, because I can win this argument just with the school of common sense. This stock is gapping down on big volume. Somebody said something, they have bad earnings, whatever it was. It doesn't even matter what it was. It makes no difference what the news was either. But the point is, there are funds selling this, maybe funds buying it. There's all this big money's involved. There's all these things going on. Do you think anybody involved in this stock is saying, oh, look at the 200? Do you think like this hedge fund gets a call from one of their big investors, the Police Benevolent Society of Baltimore, and you think that they say, hey, we want to buy 100 million shares of this stock over the next 3 days? And do you think that the fund goes, oh, wait a minute, we can't fill that order for you. You're below the 200. Do you think that's how it works? Anybody? The money that wants to buy and sell stocks, they're doing it. I mean, it's not based on this. Moving averages are just mostly irrelevant and completely irrelevant in terms of being support or resistance. There is a purpose for them. I'm going to show you in a minute what they are. But I want to emphasize to you that is completely meaningless. Oh, look at this. Well, here's a nice chart. We're gapping above the flat 200. Bullish or bearish? Completely irrelevant, Marion. You're looking at cookie cutter patterns, geometric patterns, lines drawn in triangle types. It doesn't matter it doesn't matter what shape it forms, Mary. What matters is where it is in the price cycle, where support and resistance is. Okay. What about this? Bullish, bearish? Boy, even I look at that. It's the movement all prices make all the time. It's part of the teaching. It's a long answer, but bullish or bearish? Right here, bullish or bearish? Bullish or bearish? Well, even I look at that and I go, wow, that looks kind of bullish to me. See, when you're talking about gaps, there's a way to trade gaps that supersedes everything. When we're doing gaps, we're not even looking at the price cycle. We're not looking at any of this stuff really. We are looking at support. But again, the point is when I'm doing a gap analysis, yeah, but David, I just want you to answer in terms of the moving average. I mean, all I'm saying is the moving average influence you bullish or bearish? I'm not asking for a gap analysis, right? So you can look and say, okay, it's bullish because we're on support, it's bearish because we're under this, blah, blah, blah. And you can have your final answer. And then I say, hey, look, here's the 200. Does that in any way influence you to be more bullish or bearish? And my answer to you is, especially like in a gap like this, nobody cares about this moving average. Nobody cares. I mean, maybe some traders do, some idiot dumb traders do, maybe they care about it, but they're just going to get run over. And here's the ultimate proof. If you really think this is bullish because you're gapping above the 200, right? What if you were 10 cents above, and then I said, okay, what if you were 10 cents below? The way stocks trade when they open, I mean, it could open anywhere in a 30, 40 cent area, and it just happens to open a nickel above, and you're bullish, and now it's a nickel below, and you're bearish. Do you see how completely futile thinking that is? Do you think this big money with millions of shares, do you think that they're, oh, wait a minute, we all got to sell now. We went below the 200 by 3 cents. It's ridiculous. These things don't matter. Let me go to the end slide real quick. I'm just going to fast forward real quick, because I want to say something here that some of you may be thinking here. For all these charts, I certainly understand that you could find a chart that proves that something I said does not actually work. That something I said does not work actually does work, right? So you could say, I just showed you a chart where we gapped above the 200, 100. I'm sure you could go find a chart. I could find one in probably 10 seconds where we gapped above the 200 and it stayed above the 200, right? But here's the thing. It's not about finding examples. It's about what does 1,000 charts say? That is there an edge? Do you have better odds in what you are looking at? A broken clock is right twice a day. What I'm saying is that I have studied and looked at more than thousands of charts, and I'm passing on that experience. Does everybody understand what this slide is saying? Everybody get that slide? So it's not about me finding a chart that demonstrates what I want to demonstrate. Of course I could do that. I got zillions of charts I look at every day. I'm sure you could find one where you could say, Paul, look what happened here. But the point is, it's just like if you're evaluating somebody who's selling you a piece of software. They say, look, last 20 trades, look at this thing. Here's 20 trades that have worked. Well, that's not the issue. The issue is, let's watch 100 times that software triggered, and now let's see what the results are. You're going to get a different answer than sure. And it's the same thing here, is that if you look at this over time, over many, many charts, our charts will respond differently because of where it's gapping to, where it's gapping from, all kinds of things that we look at for gaps. But the moving averages won't matter at all. It's not going to make any difference if you look at it over a long period of time. So there's no edge to doing it, and it's just this facade some traders look at. And it also becomes that thing when you look for something and you see it and you say, oh, it's right, it worked, because you only remember the times it works and you forget the times that it doesn't work. At one point, if I missed a question above, please retype it. I'm down here at the bottom. You had a lot of comments there. At one point, it sounded like you were going to reveal the magical answer to the question. Oh, I'm going to, Rob. I'm about to. How about this one here? So those are two charts. These two, to me, are completely futile uses of moving averages, and people use them all the time, and there's no edge to it at all. You can convince yourself it works, and then when you get a trade right for other reasons, you say it's part of it, but it wasn't. How about this one here? Rally to the 200 period moving average. Bullish or bearish? Some of you who are very astute may be picking up on what's going on here. You got to type more than B if you're trying to do bullish or bearish. Bearish, but I do agree, Mary, and here's a slide you're going to love, Mary. This is going to explain it all for you. Moving average being resistance is what we call self-fulfilling prophecy, Mary. Okay? You'd have a hard time explaining to me why there are actually people selling here, other than the self-fulfilling prophecy that somebody says, oh, that's a 200, let's sell. Now, the way self-fulfilling prophecy works is you run into something, a Gann line, a Fibonacci line, an RSI line, a blah, 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 or list any one of the 1,000 indicators out there. You run into some line and somebody goes, I wonder if that's going to work. And then somebody sells it and it moves down a penny. He goes, oh, it is working. And somebody else says, let's jump in. And a group of idiots jump in, and that's the end of it, right? That's what self-fulfilling prophecy is. But here's the key. I do like this chart, and somebody could tell us why. Eric, why do I like this chart? Watch the chart here, because boom, boom, boom. You see that? Because, yeah, there's an actual major resistance area here. So what you have here now is you have the self-fulfilling prophecy people who just happen to be jumping in on a real pattern. So you could call them some additional fuel for the fire, or sometimes, they become the spark. I did this other presentation like years ago, where you have a bucket of gasoline and a bucket of water, and just saying the self-fulfilling prophecy traders, which you could also call idiots for the most part, which sometimes I'm an idiot, they're the spark. But the problem is if you drop a spark onto water, nothing happens. If you drop a spark onto gasoline, it ignites. And that's what this pattern represents to me, is this is gasoline because it's a legitimate pattern. Now, if self-fulfilling prophecy people come along because there's the 200 there, because it's a Fibonacci overextension, because it's blah, 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 well, now we're all going the same direction. That's what you want to see. But when the self-fulfilling prophecy people are making a bounce inconsistent with what technical analysis says, that's when you use their stupid entries as your entry the other direction. So this is what I'd call that in-between use of a moving average that I call a little confusing, where It's if the moving average lines up with other concepts, it's okay. But it's kind of because you're not really using the moving average. But you say, hey, there's a plus. In other words, this is a plus to me. This is, yeah, I like this. I wouldn't take it just because of that, but I'm trading this. And if I'm trading that, anyone else that wants to jump in, my door is open. You want to jump in because it's Fibonacci. You want to jump in because it's the double Heimlich maneuver top or whatever you want to call it. Come on in. The water's warm. We're all happy to have you on board. Got the difference? I want best sort choices at double bottoms, double top. Do you do that? I don't. Well, I don't think you should use software to look for those. The term double top and double bottom, Mary, are not trading strategies to me. They're visual comments about a chart. You can look back and say this is the double top, but it's meaningless unless you understand what you're trading. And anytime you hit a prior low, it's not a strategy. Let me give you a classic example. Is that a double bottom, Mary? Is that a double bottom? And the next question would be, is it tradable long because it's a double bottom? No, no, and no. Putting your stop close does not make it a better trade. It makes it a worse trade in my view because you're still going to stop out and lose your money. And this is not a concept. There is no support in a downtrend at the prior low. You may jiggle around here for a second while dum-dums go, but then you're going to go lower. So that's a case where the dum-dums, calling it a double bottom, you would look to short after their rally fails, as soon as that little pop fails. So a double bottom, I don't have that in my, I have things called retest and failure patterns, but it requires a whole lot of stuff to be happening to distinguish it from what just a prior low in a downtrend is, because that's not a tradable strategy. You'll lose hand over fist going long in downtrends because you're holding at the prior low from it. All right, so next. The first two charts are fallacies about moving averages. They are not support or resistance. You don't have to go much beyond common sense to understand it. The next chart that I just showed you, this one, was somewhat helpful when self-fulfilling prophecy of the moving average lines make up real support or resistance, match real support or resistance. They can add to or be the spark to the move. Now the next slide is the primary use of moving averages. And Mary, you touched on it earlier. The only use for moving averages that really matters is simply a guide to trends. A guide to trends. When there's a presentation out there, and I think you have to be on the Platinum page to access it. But what I did was I did a test. It says test your knowledge. Well, let me do a little mini test of it right here to get this point across. I've asked this question a few times before. For everybody, and if you heard me ask this question before, just give everybody like 10 seconds to answer. When we talk about trends, people sometimes talk about an angle of ascent. Everybody, what is the perfect angle of ascent? What is the perfect angle of ascent? Like, in degrees. What's the perfect angle of ascent? Well, any time frame. I'm just saying, if you have a chart, Mary, if you have a chart, right, and you have an uptrend, what's the perfect angle of ascent? Should that line be going at 30 degrees, at 45 degrees, at 60 degrees, at 61.9 degrees? Yes, DFG, yes, it should. Now, all of you given the right answer, you didn't know that before, because when I asked this question a long time ago, nobody figured this out. So you're, yeah. Well, here's the purpose. Here's the point: is that there is no angle of ascent. It's anybody who throws out the answer 45, which I get a lot of times, is reading garbage on the internet. There's no such thing as an angle of ascent. Yeah, I know. Like I said this many times, so you probably got it. Because here's why: if your chart is like this on your platform, if you make tall, skinny charts, or if I have a short, fat chart, right? The same exact chart, my angle is going to be 30 degrees and you're going to be 60 degrees. That's just how you skew your charts, the width of your bars, all that good stuff. And that's to me what a moving average does for you, is that it puts the price in perspective. You see what I'm saying? If I look at 30 degrees, that's going to be way off if I make my chart tall, right? My price is going to be like this. But the moving average is a stable but yet adjusting concept. Yeah, DF, if I took like this chart right here, let's say it's a kind of a wide chart, right? So let's say that's a 30-degree angle, right? DF, if I took this exact same price, if I went to my platform right now and I took my chart and instead of making it that, if I went to another page and I had my chart like this, right? this exact price pattern, the angle of ascent, would be like this. Agree? I'm talking about somebody who talks about like you measure 45 degrees on your monitor. That's what I'm talking about. Okay? Does that make sense, DF? So my point being is there is no angle of ascent. It's a ridiculous statement, people that say that. It depends how you, and not just the size, not just the width and height of your charts, but also the bar spacing and how fat your bars are. And what if you have like 3 different indicators down here, right? And it squishes the price pattern even more because now you're using up half your chart with indicators. Yeah, well it is. Yeah, like that's the internet technical analysis crackerjack book that people learn by. And I can tell when I get certain answers, I'm like, okay, you're just reading garbage. You're never going to make money doing that, and you can see why. So let's get back to this. So this is blue is a 20, which is. Oh yeah, I'm sorry. You're right. Yeah, yes. I'm not going to. Yes, I just pointed at the wrong ones. Yes, that's the 20, and that's the 40. Obviously, thank you. Yes, the 20 hugs tighter, of course. Obviously, yes. Though that's correct. Sorry about that. So if you're listening to this on the recording, these are backwards, 2040. Okay. But let's talk a little more about this. A couple of things on this chart. This is what moving averages do, is they give us some perspective. And another example I like to use is if we start, like if I didn't have moving averages on here, it's hard for me to tell how quote unquote extended that is, or that is, or that is. Because if price is always moving up, and the highs are getting higher and the lows are getting significantly higher, it's hard to tell that that's accelerating to some degree, right? You can tell that's accelerating some, but it's the moving average that gives you perspective on all of this. It's like, I always say, it's like, what if you were dropped, what if somebody in one of those game shows, they drop you in a helicopter to the middle of the desert with a blindfold on, and you take your blindfold off, and every direction you can see is nothing but sand. And then in the distance, you see an orange sphere out there. Let's make it red because that's the color I have here. You see a red sphere out. No, it's got to be orange. In the distance, you see an orange sphere. And you're in the desert, and you can't see anything else but sand. You see an orange sphere out there, way far away. Do you know if that's a basketball that's 100 yards away? Or if it's a 6-foot big oil ball that's a quarter mile away? Or if it's a orange parachute that just came down a mile away? Can you tell? Yes, Mary, of course we identify support and resistance. That's a big part of trading. It's not, but let me finish my moving average thing here. An amazing thing about moving averages are just a mathematical computation of what's happened in the past projected forward. And you really don't need them on the screen. So a couple of points are, number one, this is the 20 and 40 simple. If you're going to put moving averages on your charts, number one, I don't care if you do or not. I like them on there for this reason I'm telling you, but it doesn't matter. I don't care if you use exponential or simple. It doesn't matter. Arithmetic doesn't matter. I don't care if you want to use the 13 and the 39 and the 172. It doesn't matter. None of that matters. What matters is, to some degree, is that most traders look at this stuff so you can get that self-fulfilling prophecy concept. Moving average crossover is completely meaningless. Get that out of your head right now. It's completely meaningless. There's nothing to discuss. There's nothing to talk about. Moving average crossovers are completely meaningless. All right? Yes, when they crossed, it means that the price had moved up, but they're not entry concepts. It's useless to discuss it because all you can say is that, well, for this moving average, the 20 to be dragged back above the 40, it means the price had to have rallied. Okay, but that doesn't mean it's going to keep rallying. Any dead cat bounce, the moving averages will cross and you're going lower. All kinds of examples. It just doesn't matter. Yeah, the golden cross, right? Exactly. So none of that matters. I have a question here, though. So this, to me, is just when there's 3 things we look at in trends, right? And most of you guys know that the location stuff. There's retracement, there's moving average, and there's minor support. And what's amazing is if you have a chart where every rally is twice what the next pullback is, right? If that's the pattern you have, which, by the way, is not unusual because some traders selling some of their stock, and that's typical. If you have that pattern, what's amazing is you will always be pulling back on minor support. You'll always be pulling back about 50%. And amazingly, the 20-period moving average will snug right up in there. So it's just a nice little thing that gives you some perspective. Right, it's I don't know what a measure move is. I've heard different definitions of that, but it gives you a nice perspective of what's going on. But let me ask you another question on this chart. So based on moving average without seeing anything else, obviously, these are just really nice areas because an uptrend developed, and that now we see that these are areas of mathematical probability to some degree, but they're not support. We get up to here though, right? And what does that start telling you when we're up there? Oh yeah, right, Craig. That's what I'm saying. There's no doubt you can find charts where, wow, the crossover, that was the thing. Because see, here's the thing, Graves. I'm glad you said that. Here's a beautiful chart, right? And I could probably go find 30 stupid technical concepts that worked on this chart, right? Including the fact, you know what I like about this chart too? It started with a J, right? Anything that starts with a J on Wednesday is a good long, right? You know that, don't you? See, all that stuff works. The problem is when the chart doesn't work, right? And you're using one of those dumb things and you don't realize it. So it's about getting odds in your favor. But let's go into this. So what about this up here? Yes, that is a joke, Mary. You don't know me that well. I tell a lot of jokes. That is a joke. But it does make a point. It's not just a funny joke. It makes a point. A lot of things traders look at to me, Mary, is no different than saying, oh, I went long because the stock started with a J. It's a famous thing. If you're in a bull market and you go long, you can go long because the stock started with a J, because it hit the double Heimlich maneuver crossover line, because it, whatever. You could be the biggest dum-dum in the world. If you just go long in a bull market, you could be way off and still make some money. The question is, what happens when the bull market isn't there? And, long term, that's not as often of a question, but like day trading, it's every day that happens, that we have to stop going long for some reason, right? I'm good at the double Heimlich, yes. But let's get back to this question, because I have one more point I want to make on this chart. Up in here, tell me about that up in there, based on the magic moving averages that we're looking at. I have two charts left. We're running over. I knew it. Okay, extended. Yeah, extended is just like a double top to me. It's a term we can use in English. It doesn't mean much to me. Well, here's the C plus answer to me. And it's not fair. I'm not, please, in this case, don't think I'm criticizing anybody who said extended. Looking at this chart, I would agree it's extended. But here's the question. What does that mean? And the C plus answer is just to look at this chart and say, well, okay, it's extended. But what would the next question you want to know is? Yeah, it may pull back. It is extended from the moving average, blah, 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 blah. Yeah, partly, Mike, but yeah, where's it going? Thanks, Rob. I'd kind of want to know, where is this living in the other time frame, right? This is a 5-minute chart. In other words, what if this 5-minute chart was happening on an hourly chart that looked like this? I'd be shorting that. But what if it was happening on, you ready for this? Here's the hourly chart for JP. This is today, by the way. This is hot off the press, right before I started the presentation. What if the hourly chart looked like that? See, and here's the key, is that if you're day trading, hourly chart's your guide. And guess what? We started this move. Look where we started it. Hey, moving average crossover. There it is again. So if you started the move on the hourly chart there, it kind of gets a thumbs up. And then look what else happened here on this one. We just broke above that. We just broke above the other day. So, I probably wouldn't go long that chart just because of what it is, but I'm just saying it can be justified because you're just looking at one chart, and that's why we don't look at just one chart. By the way, even that moving average crossover, though, would have you in way late. You'd be in on the third bar. Exactly, Mary, right. We never know where it's going. We just have what we feel is a good statistical probability that we're going to be right based on looking at the cross-section, Mary, the battle and the bulls across 4 pertinent time frames. So one more chart left. So again, looking at our moving average concept and using it as a gauge, as a judge toward trends, as a guide toward trends, based on the moving averages. Going long in here, good idea or not? Yes or no? Why not, Mary? And for the rest of you, going long. I'm with the setup, but I just mean, is that generally the area I want to be? Should I be looking for a long in there? I don't mean on the red bar necessarily, but I mean, what's a daily chart? I'm not sure you can justify by saying it went from 135 to 70. What if it goes to 280? Now, see, here's another, and this is the final use for moving averages, right? The important use is a guide toward trends. It's a guide toward trends. Rob, you're going to punch yourself because this is extremely similar to a chart that's in the manual. I call it the punch in the gut slide. Remember that one? I would never go long. I would never go long that chart. Not on a green candle, not on a double Heimlich crossover, whatever you want. I wouldn't go long at all. This chart is no longer in consideration to be long because of the moving averages. That's the other guide because of this splitting apart. The fact we barely made that new high, it's going to be the end of a trend coming up. It's going to be the end. And you have to recognize this. And part of that, the reason they're splitting, I mean, what you have to learn to understand and to read is this. I'm going to do this one last thing with you guys. We rally and we have profit taking, right? This is a sloppy chart, by the way, but we rally and we have profit taking, right? Everybody's happy. That's why we're kind of holding that moving average on the way up. We rally and we're a little skimpy on the profit taking, right? We rally again and people start taking profits now because they weren't happy because nobody took them before. So now we have more built up people that need to take profits. And that's what you're seeing is when you don't get pullbacks. When you don't get pullbacks, you're building up profit takers. And then when you have the next pullback, people tend to say, okay, I need to get my money, and they get out. So that's just, how you look at odds on something like that. So there you go. There is the correct use of moving averages. There's that slide that I read to you a little while back. And I'm at the bottom here. If you have any questions, feel free. I'm done with my presentation. Hope you enjoyed this one. Again, I want to remind you that these are a few potent but little microcosms of the big picture of trading and learning how to read a chart. So I showed you a couple of favorite things. I wanted to get across to you, how important some of these things are and how much there is to learn. Because even what I talked about, I just touched on some of the topics, whether it's how to use a moving average or whether it was back in the very beginning slides when we were talking about volume, just touching on some of the concepts. But what I was trying to do is take just a very small little microcosm of the bigger picture of reading a chart and just show you what is involved in some of this. That it's not, moving average crossovers, and it's not moving averages or support. You can see if you really want to learn to make money, for those of you that have not, I suggest you really get an excellent understanding program education on how to read charts, because there is a lot to it. If you don't like me, find somebody that you really like. But just trying to show you what there is to learn. There's a lot to learn out there. And if you're successful and you're making money consistently over several months in different environments, congratulations. Whatever you're doing is great. But if you're struggling, think about what you're looking at. Good demonstration. Thank you very much. It's probability rules are only possible to follow because the conditions and change quickly. Protect stop losses. Well, let me give you another comment, Mary. You don't know me very well. Absolutely, positively. I mean, most new traders, a lot of new traders go broke because they don't follow stop losses. You want to hear the next comment, Mary? Are you sitting down? And make sure you move the coffee or the margarita far away from you. Most intermediate or pretty good traders go broke because they do follow their stop losses, maybe in an inappropriate manner. Stop losses probably cause more people from going out of business trading than anything else, improperly used. Yeah. Well, I have one I put in the intro class, Mike, that is probably like that. It must have 13 different indicators on it. Questions here? Mark, thanks. Need more questions? Because obviously you have to know, where your projected stop is going to affect your sizing on the position, obviously. All right. I see a couple more comments coming, and then we'll call it a night. FL Trader, you got to love FL Trader. Trades from the Foot Locker. Thanks for joining us, Mary. Thanks for your comments. What happened to FL Trader? FL, where are you? I was waiting for your comment. Dad of wine, okay. There he is. All right, welcome, FL. All right. Okay. Have a good night, everybody.